Hello folks, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital Markets. Today's topic is on the airline industry. Right? We're going to explore a number of topics on bottom fishing. Right? Is it time? Have they been beaten up enough? Alright, so let's jump right into it here. And I entitled this first chart, Are We There Yet? Again, have we seen the worst? We have the resurgence in the virus. So have we seen the worst? We could have been talking about hotels, cruise lines, car rentals, but today we're going to focus on airlines. All right, airlines today are down about 50% on a year-to-date basis. Right, 50%. Now that is actually far better than they were earlier in the year. They were down 65, 67% earlier in the year, and we had this huge run-up. A lot of people said it was due to the Robin Hood crowd. I don't know if there's any validity to that or not, but we had this huge run-up, and it's given part of that back, and now we're down 50. So again, a max of down, call it 65, and we recovered about 15%. So some ideas. Where do we go from here? Again, is this a good time to buy or not? That's the difficult question. And the punchline is, in general, I don't think it is. I think the environment is still going to continue to be very challenging for the airline industry. And that's even true without a tremendous resurgence in the virus, without the second wave. It's just the traveler mentality is going to take a while to heal. Now let's take a look at this. Let's start with profit margins here. Profit margins, we have Southwest here on the top, American and so forth. And you can see the profit margins for all the major airlines have just collapsed. Look how thin these profit margins are. They're thinner than a supermodel. Oh my gosh, if they were an animal, we would deworm them. They're so damn thin. That is not a good scenario. And that is true for the entire industry. Now, some, you'll notice, have held up better than other ones. Southwest, for instance, has held up better than some of the other airlines. But they're all collapsing, right? The profit margins everywhere is just collapsing. That is a problem. Now, you lay that on top of the background we started with, right? It's not like the infrastructure here was a well-made building by any stretch. Check these out. The credit ratings, the S&P credit ratings here. And I have Southwest highlighted here. It's the only investment-grade airline out of the major U.S. airlines that we're going to talk about today. Everything else is already junk and fairly low on the junk status. You can see Hawaiian here at CCC. So we weren't starting off with a real sound foundation to begin with, and now we have this. And the virus just keeps coming. The spillover effects from the first round of the virus, and of course now we have a resurgence in the second round. So let's take a look. What's that done to airline traffic? So here we have a chart of domestic and international airline flights, and we're starting here right at the beginning of the virus. The dark blue line is the U.S. Domestic airlines. We're running about 10,000 per day. They dipped to nearly 2,000, from 10,000 a day to 2,000, and they recovered a little bit. Let's call it 5,500 or so. All right, they recovered a little bit, but they still have a long ways to go. And then on this chart, of course, we also have international. International actually looks even worse. Is that possible? Look at this thing. It fell off the cliff just like domestic, but it's just not come back. It's not coming back here. That is hard to believe. We're in the middle of earnings season here, and of course some of the airlines are starting to report right now. Of course, if you have nobody flying, you can make no money, and you have other additional costs to worry. But the big one is this, right? I said, right, airlines, I don't particularly care for the airlines now, even if the resurgence doesn't amount to much. And that doesn't look to be the case. But even if it doesn't, there's still a problem here, right? And the big problem is the travel advisories. It's the 2-week quarantine, whether it's self-quarantine or not, right? If you go to many countries, you don't have a choice. You have mandatory quarantine. So the international flights are obviously affected by this. Think about this. You fly to, China, choose about any country, and you're required to stay in a hotel room for 2 weeks, pay for the hotel room, eat your meals out for 2 weeks. Obviously, the cost of an airline ticket just skyrockets. Who's going to want to do that? And oh, by the way, you got 2 weeks on the flip side when you come back as well. That's the crazy part, right? The mandatory stuff. That's what's really hurting the international flight. But even look at within the U.S. Notice this. This is the Newark sign here. New Jersey has a suggested quarantine against 16 states. 16 states. Well, of course, California can have a different group of states. May have 16, may have 20, may have 4. Michigan may have a different group of states, right? It's just confusing as all get out. And of course, a lot of people are just skipping the self-quarantine side of it. As long as it's not mandatory, they're not getting real excited about it. And others are just choosing not to fly at all. So here's the bottom line, right? There's just less flying in general. Increased safety measures are obviously increasing costs, increased sanitation measures. Of course, we went from negative $40 oil to plus $40 oil. I imagine jet fuel costs went up proportionally with that, plus, right? So we got less demand and, of course, higher costs. We could be looking at years until profitability here, ladies and gentlemen. This is not a good remedy. So if you're thinking about maybe a 2-week trade, something like that, a risk appetite trade, maybe you want to think about the airlines. But unless you're planning on them getting a massive bailout package, that's really a stretch. Now, why are they going to need a bailout package? Here we're looking at net debt to EBITDA, right? It's often referred to as the leverage turns. Look at this thing. Look at this bad boy. Look at this bad boy for the U.S. airline industry. It has just popped. And in fact, it was increasing ahead of time and then took a big step up. All right, so the airlines have already received a $25 billion package, right? It was part of the CARES Act, and a function of the CARES Act is the PPP, the payroll protection. So that guarantees the salaries through October for the airline industry. Well, for a certain number of the members of the airline industry. Now, that's up for renewal, right? That $25 billion. They received that already, but that's for the employees, not for the airline companies. Big difference. Now, as part of the CARES Act, there was another $25 billion that the airlines could take down as a loan, as a low-interest loan if they wanted to. But again, that's a completely different feature to this. So now that we're getting closer and closer to October and the deadline approaches, if they're not giving another bailout package, we could be seeing some massive layoffs coming at us. I can't remember if it was United or American. One of them had already announced 30,000 employees in a bailout package. And then on top of that, they were looking to downsize another 130,000 people. We are not talking about a trivial amount here. This is not just an airline issue. This could bleed over into the entire general economy, right? Affect the overall labor market. All right, so what we tried to do, again, on a longer term basis, we just, we're like Warren Buffett. You remember when Buffett was in the news recently, he had dumped all his airline stocks. He says, I've had it. I've had enough. I'm gone. And we still hold that view as well. But if you were looking for it as a shorter term play, then you got to worry about the debt levels, right? That previous chart I just showed you, the debt to earnings. Earnings are falling, the debt's going up. You got to worry about that. So we tried to put together a chart for you to analyze the short-term liquidity of the various airline industries. So let's take a look at that right now. So this chart has many different columns, but what you want to focus on here is the final column here, the far outside column here. This has the CARES Act built into it. It has existing debt that's going to be due here. So what we're talking about here is coverage ratios, liquidity needed over the very near term here, this year and next year. And based on our calculations, and again, there could be errors in our calculations, but based on our internal calculations, we see that Southwest is in the best shape of everyone right now. At the other end of the spectrum is going to be American Airlines. Also down there with American, of course, is going to be Spirit Airlines and so forth. We also have Delta. Delta with Southwest is being two of the more attractive airlines. So again, if you wanted to think about this as a short-term basis, you might want to think about trying to find the least ugly pig here. Or perhaps you want to think about it as a pair trade. You could think about that as a possibility as well. But again, in all cases, I would think about this as a short-term trade, as a liquidity trade, as an oversold trade perhaps, and it's going to bounce. On a long-term basis, I just don't see it. It looks like we're going to have more mergers within this industry, right? So there's already been the announced affiliation between American and JetBlue, and perhaps we'll see more things like that going forward here. All right, so that's our message for today. I'm Don Rich, and you've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.